Centuries to come. The concept of shared risk and community support that we saw in ancient Babylon found fertile ground in ancient Greece and Rome. These civilizations, known for their emphasis on community and civic duty, developed their own unique forms of mutual aid societies. These societies, often organized around professions or neighborhoods, provided assistance to members in times of need. In ancient Rome, for instance, burial societies emerged as a way for people to ensure a proper burial for themselves and their loved ones. For a small regular contribution, members could have peace of mind knowing that their final expenses would be taken care of. These societies also served as social networks, fostering a sense of belonging and mutual support among their members. Fast forward to medieval Europe, a time of guilds and crafts. Guilds were associations of merchants and artisans who banded together to protect their interests. They played a vital role in regulating trade, setting standards for craftsmanship, and providing social support for their members. Much like the mutual aid societies of earlier times, guilds offered assistance to members facing hardship, including illness, disability, or the loss of their workshop in a fire. These early examples from history highlight a recurring theme: the human desire for security and protection against the unknown. Whether it was the Code of Hammurabi offering a safety net for traders, Roman burial societies easing anxiety about final expenses, or medieval guilds providing a safety net for craftsmen, people have always sought ways to mitigate risks and face the future with greater confidence. The year 1666 marked a turning point in the history of insurance. In early September of that year, a fire broke out in a baker's shop on Pudding Lane in London. The Great Fire of London, as it came to be known, raged for days, consuming everything in its path. By the time the fire was finally extinguished, it had destroyed over 13,000 homes, 87 churches, and countless businesses. The devastation was unimaginable. The Great Fire of London exposed the inadequacy of existing firefighting methods and the lack of a systematic way to deal with such widespread destruction. In the aftermath of this disaster, a new sense of urgency arose around the need for fire insurance. People realized that a single spark could wipe out their life savings in an instant. The demand for a way to protect oneself against such calamities had never been greater. It was against this backdrop that the first fire insurance companies were established. One of the pioneers in this field was Nicholas Barbin, an economist and property developer who had witnessed the devastation firsthand. In 1667, he founded the Insurance Office for Houses, which offered fire insurance policies to homeowners. This marked a significant shift from the informal systems of the past to a more formalized and commercial approach to insurance. The concept of fire insurance spread rapidly, and soon other companies emerged, offering protection against fire and other perils. These early insurance companies faced numerous challenges. They had to develop methods for assessing risk, setting premiums, and managing claims. It was a period of experimentation and innovation as the insurance industry grappled with the complexities of this new business.